Hello, everyone. Welcome back to another Lunch and Learn webinar series. I'm your host, Mayur Thaker. I am an equity strategist here at Zacks Investment Research. And this is a presentation on the Q1 2026 earnings season, a total review of everything that we have learned so far as S&P 500 earnings are concerned and looking at some of the forward guidance that we're getting from major companies as well as on a sector level basis. This is one of the most incredible earning seasons that we have all ever witnessed, at least in our adult lifetimes. And it's very, very important that we understand exactly what just happened and what that means for the rest of 2026 and possibly well into 2027. So let's get started on what just happened and what that means going forward. This was the best earning season in over a decade, probably in our, again, like I said, our entire adult lives. We have seen in Q1 of 2026 24.1% blended earnings growth. This is based on all the companies that have reported Q1 so far, which is the vast majority of companies in the S&P 500 now have reported. And then if you add on the remaining companies that haven't yet reported, but we have, a good understanding of the estimates for what they are likely to report, the blended growth between the actuals and the estimated for Q1 is now 24.1%. Again, the best in over a decade. We've actually seen better earnings growth, but there's a very specific time when we've seen even better earnings growth, and that is exiting recessions, right? As we exit a recession, right, the year-over-year growth rate looks stellar, right? It looks stupendous, right? Because the growth on a year-over-year basis is based on a very depressed number from the prior year due to the recession. So there are cases where earnings growth can be in the triple digits, like we had in 2010, 2011. We did see incredible growth rate of earnings, but again, that is sort of a data mirage, if you will. It's not the long run steady state earnings growth. It is the growth because of a major sharp recovery in the economy. Whereas today's growth rate of 24% is based on already strong earnings. In fact, the earnings have already been at fresh record highs even before Q1. So that's what makes this number even more impressive. And that's why I say I think that this might be the most impressive earnings cycle in a very, very long time. In fact, I probably think we don't even have you could probably stretch all the way back 30 plus years before the last time we saw earnings growth quite like this, where 80% of companies are beating their estimates, 78% are beating the top line estimate. This is now the sixth consecutive double-digit growth quarter. Again, that's why I said this is such an impressive number, because this is now the sixth quarter in a row where we've seen S&P total earnings grow at double digits. This is absolutely phenomenal growth, well above the 5-year average, and the strongest quarterly performance since at least Q4 of 2021. Again, like I said, because in Q4 of 2021, the comps were depressed because of Q4 2020. The economy was still recovering from the pandemic. Let's take a look at, the earnings decomposition by sector. Here we can see autos are actually leading the way. It's not even technology, but it's autos. That's a little bit misleading again because of the principle, like I just said. Autos are coming off of a unusually weak 2025, and so that's why they're having a very sharp recovery. Some of that is also explained by inflation. We are seeing inflation creep back into the economy, which will help the residual values of used cars, and that also sort of pads the margins of the automakers. In addition to a cyclical recovery in auto sales after a soft 2025. So that's why we're actually seeing a huge contribution from autos on a year-over-year growth basis on earnings. But as we see here, as usual, the usual suspects of technology continue to power the market forward. Technology reported 44% earnings growth. But here's the other thing, too. Even outside of technology, we're seeing significant contribution from other sectors, too, like materials and financials, two cyclical sectors here. Usually that is very, very promising because when cyclical sectors like materials and financials do well, that's a great sign of the underlying health of the economy. Because technology, these are secular compounders. They typically go up over time anyway. Um, they're continuously reinvesting capital for growth. So these are, that's a sector that isn't usually susceptible to economic cycles, but materials and banks certainly are. So it's very good to see them put forward a very strong contribution to earnings growth as well. Utilities, surprisingly, they are sort of like the new technology, especially energy utilities, but also um, because there is a massive new demand for power because of the incredible data center build out that we have been witnessing now for a little more than 2 years now. Energy stocks, especially electrical utilities, are seeing incredible surge of demand. And so utilities are growing like their technology at 15%. Again, that's unheard of. Um, but also very strong results from industrials, aerospace, and rounding out the top of the list is transportation. Again, very, very bullish from both secular compounders as well as cyclical sectors. So again, very, very strong growth overall. But you can see also that the growth is being shared across multiple different sectors. So that's very good to see the breadth of earnings continue to be very strong. Now, obviously, a huge part of this 25% earnings growth is the AI trade, the AI space, Mag 7. That is continues to be the engine of growth here. So those, big seven companies basically drove 71% of the S&P 500's earnings dollar increase in terms of the dollar growth, the earnings per share dollar growth. 71% of that growth in dollar terms is coming from the Mag 7. Again, that's because of the massive skew that these seven companies continue to have on the aggregate numbers just because they are so profitable, so large, that yeah, it is they're having a disproportionate effect on the aggregate dollar value of S&P 500 earnings. But if you look at it on a growth rate basis, aggregate growth for the Mag 7 was 23% again in Q1. Alphabet alone, contributed a significant portion of that 81% growth in net income for Alphabet just by themselves. So again, this is a very, very Mag 7 heavy story. But also, if you zoom out, even from outside the Mag 7, the semiconductors in general, especially the big story there, which has been Micron having a windfall growth, and that's having an outsized impact on the semiconductor sector, even though Micron is more a memory story than true semiconductors. Still, if you combine them together, that sector or that industry has reported 95% earnings growth year over year. Just absolutely stunning how much demand is coming in for the entire semiconductor apparatus, from the GPUs to the CPUs to the memory chips to the wafers to the wafer designers like Broadcom. and Lamb Research and others, and of course, all of the suppliers for these industries, all benefiting, all riding the coattails of the incredible wave of CapEx spend, and we're going to get to that a little bit more in a few slides from now. But also something that we can't ignore, financials. Financials have been the one other sector of the economy that's not directly related to the AI's data center build out, but financials are reporting very strong earnings themselves, 25% growth in Q1. This is being driven by strong net interest margin expansion. They're also doing quite well with trading. The prop desk trading is doing really well. Q1 is probably going to be the strongest quarter of the year for the sector. The remainder of 2026 isn't expected to be as strong as Q1, but because of such a strong, start to the year, uh, estimates have been revised up across the board, including for financials. So that's again another major tailwind for the market. Here we see a chart of the S&P 500's earnings growth on a quarterly basis, year-over-year growth. And you can see that the growth has already been very impressive. You can see it's been at 15% every quarter on a year-over-year basis throughout 2024 and 2025. But now the growth is even more substantial. It was already breaking out in Q4 of last year, hitting the upper, teens, and now it's broken out significantly to well above 20%, almost at 25% year over year. Now that growth is expected to moderate a little bit. It should fall back to 20%, but still very, very impressive growth nonetheless. And that growth is expected to stay high, well north of 15% for the remainder of 2026 and well into 2027, just because of how big the backlog is reported to be. And we'll take a look at some of those data points as well in a few slides from now. So the full year outlook for 2026 has been revised up significantly. We're now looking at $335 of earnings. That's according to Zacks. That's about 19.5% year-over-year growth for the full year. So again, because we got 24% growth in Q1, and if the full year is 19%, then yeah, that's basically suggesting that the rest of 2026 won't be as stellar as Q1, but still very, very strong nonetheless. Coming in at just about 20% for the full year. That is, again, a incredible number for, the size of the S&P 500 that we're at today. And given the fact that earnings entering the year were already bullish, 2025 was yet another banner year for the market, both in returns and in earnings growth as well. Earnings hitting fresh all-time highs again. And so to grow another 20% on top of that is something truly remarkable. It's a very special time period. But we're going to look at exactly why that is and how this is happening. But for now, the story has been very strong growth, primarily concentrated in technology and semiconductors. But because of that incredible growth and surge in demand for silicon and the entire apparatus that surrounds it, it's giving a tailwind to multiple other industries as well, including energy, industrials, materials, um, and all of the other company and manufacturing as well. Now, AI CapEx demand, right? AI beneficiaries expected to represent 50% of total S&P 500 earnings growth this year and next year. The Big Four combined CapEx of $725 billion funds this entire ecosystem. So again, a huge part, in fact, the majority of this growth is because of this above average, well above trend growth in CapEx. That is a both tailwind that's both bullish in the sense that it's providing significant support to the market for the foreseeable future, but it's also going to pose a risk down the line, which is that, what goes up will eventually come down because companies can't sustain growth in CapEx like this in perpetuity, right? This is extraordinary, 2 to 3 standard deviation above trend growth in CapEx. That can't continue forever. Remember, CapEx is inherently a cyclical phenomenon, and once the build out is largely complete, that growth will slow. And when that slows, it may even dip negative on a year-over-year basis. And when that happens, we will see some significant pressure on earnings when that happens. However, when that happens could be a few years from now. We'll take a look at some of that as well. Another key risk here, inflation, both the PCE price deflator as well as the CPI, they both ironically settled at 3.8% year over year. But again, that's the highest inflation rate since May of 2023. This really threatens 3 years of progress that we've made on getting inflation down and towards the Fed's long-term goal of 2%. And now we're starting to head in the opposite direction here. And that was triggered by the Iran war and the subsequent closure of the Strait of Hormuz, which is causing massive backlogs in the ability to transport oil and natural gas worldwide. And futures markets believe that this is going to persist for some time. If you look at September futures for WTI crude, those futures are still sitting well above $80 a barrel. And so that's, at least 25 to 30% higher than where they were just before the Iran war broke out. So inflation is most likely headed back up. Um, Even if there is some sort of resolution with the Iran conflict, it's not likely that the backlog is going to be cleared anytime soon. And so the longer oil stays high, the greater the likelihood that that inflated price seeps into consumer prices across the board, and that puts significant pressure on consumers. And we've already started to see that right now. But right now, thankfully, um, the top 20% income earners aren't feeling as big of a pinch as the bottom 80% are, which is usually the case anytime anyway. But because the top 20% are doing fine and continuing to spend, in addition to extraordinary spending from the hyperscalers, these two groups of people, or these two groups, right? Both the top 20% income earners combined with the 2 standard deviation move um, in terms of, CapEx is basically lifting the entire US economy and keeping it afloat. Despite the slowdown in the lower 80% in terms of retail sales, um, these two forces are enough to keep earnings extraordinarily bullish for the time being. But that is what sets up the risk, in my view, beginning in 2028. So we'll take a look at that as well in the next couple of slides. So for the 2026, the EPS growth contribution, again, like I said, half of this growth is coming from AI beneficiaries. That includes the semiconductors, all of the AI hardware companies and infrastructure suppliers, all of your cabling companies, all of the companies that make the small power electronics and switches and cooling devices and things like that. These, and in addition to big companies like Caterpillar, right? Caterpillar also had a very bullish earnings report. They're not technically in this sector, right, as a construction company. They're more an industrial company, but you can see that they are also having a big tailwind because of the huge demand in data center construction. And so if Caterpillar does well, imagine all of the hundreds of suppliers that feed Caterpillar for manufacturing their heavy duty construction equipment. And so Caterpillar is placing large orders to their tier one suppliers. And so you can see how this bleeds into the rest of the economy. It seeps every dollar that's spent on data centers, some portion of that goes to all of these downstream companies that are, either the direct uh, first derivative or even second and third derivative supplier of data centers. And so that, literally, it creates this waterfall approach that benefits many, many different parties and therefore puts earnings up across the board, across multiple sectors. And that's why we're seeing that happen today. Again, so in summary, record earnings season. But again, there are elevated risks. The bull case, very strong growth. The full year guidance remains very strong. AI CapEx demand structurally durable well into 2027. Positive guidance above historical averages. We're seeing that from, Jensen Huang at NVIDIA, Lisa Su at AMD, TSMC. Some of their commentary has been very bullish and constructive. So yeah, backlogs are very durable, and that's going to last well into 2027, possibly throughout 2027. But the big debate, really starts in 2028. Remember, there is still a very large concentration risk if Mag 7 CapEx guidance starts to slow, right? The AI CapEx cycle right now is very strong, but remember, it is inherently cyclical. So that CapEx will slow. That doesn't represent steady state um, growth. CapEx is opportunistic. It can turn on when there is an opportunity, and it can turn off when that opportunity ends. And so that's why it's something that we need to be, cognizant of and aware of. Um, like I said, this CapEx super cycle is driving earnings, but it's not steady state growth. Here we can see a chart of CapEx growth on a year-over-year basis. Again, very strong Q3 of 2025, right? That's when it really got going at 75% growth year over year. But you can see that this has been steadily slowing down. And that's what we would expect because these are very huge numbers. They're insane, like they're incredibly large numbers. Remember, we're already looking at total CapEx in north of $800 billion total if you count everybody in there. So of course, we're looking at staggering numbers. So one would expect for this to slow to something a little bit more reasonable, that's long-term durable. Here you can see that 2026, um, growth is expected to be at 25%. And in 2027, that's expected to slow to 15%. And then the big question starts in 2028. If the CapEx build out, if the data center build out reaches completion or near completion, are companies going to start to say, okay, it's time to start showing ROI on this? Otherwise, we're going to cut down our CapEx spend on these projects. So if this trend continues, I would not be surprised to see 2028 slow to something into the single digits, possibly even zero, and also very possibly negative. It could be negative. CapEx again it's not the same thing as revenue or earnings. CapEx can be up and it can be down as well on a year-over-year basis. This is inherently a cyclical, discretionary item. So if this flips negative, but in 2028, that will put incredible pressure on S&P 500 to come up with the difference elsewhere. And that's going to have to be made up by consumers because remember, consumers historically drive earnings growth. During steady state expansion periods, during steady state bull markets, CapEx is a contributing factor to growth, but the vast majority of growth on a dollar basis comes from consumer spending. And right now, consumers are not spending as fast as companies are spending on AI CapEx. And that number now is quickly approaching one to one. Of course, consumer spending is still the lion's share of the economy, the lion's share of GDP, and therefore the lion's share of total S&P earnings. In one way or another, all companies are exposed to consumer spending. But once companies slow this discretionary CapEx, will the consumer be ready to step up and replace that lost revenue? That question remains to be seen. But this is something to be aware of. CapEx can certainly guide growth, but CapEx ultimately is cyclical. And at some point, this will slow and possibly flip negative. The question is still when. And that's why I think that given what we know today from guidance issued by some of the bellwethers out there, NVIDIA and AMD, 2027 earnings are still safe. And so that's why the market should continue to do well for the remainder of 2026 and possibly well into 2027. Um, if the guidance for 2028 remains strong. So if there continues to be a backlog for GPUs and CPUs and possibly, this new chip that Google has been working on with TPUs, if that backlog continues to be large, well into 2027, then we can have some ease to say that 2028 will continue to be strong, maybe not as strong as 2026, but still something that is quite strong and enough to support the market where it is today. ASML, which is the sole EUV provider for all chip manufacturing, they reported that they carry a record backlog through 2027. TSMC as well said that they're sold out at least through mid 2027 with no cancellations reported. So again, backlogs are very strong, and that's what's supporting the market. That's what's supporting continued CapEx visibility well into 2027. But 2028 again is where the debate begins. Um, so the bottom line here is that the CapEx cycle is real, but premature for this year and next year. So investors should monitor Big Four CapEx announcements. I would say in late 2027, but really in the beginning of 2027, as the earliest leading indicator of whether the cycle is extending or if it's turning. This is probably the most important takeaway from this. So again, very bullish earnings backdrop. It's looking bullish for the rest of 2026 and 2027. But starting early next year, I would really pay attention very carefully to what these big companies are saying with regards to their CapEx plans. I would love to hear from you. Any questions, any feedback, please do reach out to us at 1-866-794-6065. You can send us an email to researchdesk@zackspro.com or reach us on either LinkedIn or on X at these handles provided here. All right, everybody, talk to you soon. Take care. Bye.